Hey everyone, and welcome back. Thanks for joining us. Today we are going to go through a bullish strategy and one that we've heard a lot from lots of our users. And what it is essentially ways that you can be re-owning bushels that you have already physically sold. I know re-owning isn't a real word, but it's definitely a term that's used in our industry to refer to basically getting back in the market. So we're going to go through how you can stay in the market when you've already sold your physical, a bullish strategy. So re-owning bushels, what is it? So essentially you have sold your physical bushels already. And you might say, I wish I didn't sell at that price. I felt forced to. I want to get back in the market. So what you can do is buy a call option or a futures outright. Um, this gives you gaining you exposure back to the market without you having to risk more bushels to sell to the physical elevators, crushers, any of the buyers here. So re-owning them, when to use them. So generally, we'll be selling our physical to generate cash flow at harvest. We might need to create some more space, so we might be forced into a sale, or we just don't have any on-farm storage and the logistics make sense that we just have to sell everything at harvest. So all our physical is gone. And now we want to find a way that we can essentially re-own that without going through, costly contract cancellations with the buyer. So why would you use this? It allows you to get back in the market on those equivalent bushels that you already physically sold. You can participate in any upside movements without needing more physical to sell again. So say if you did 20, 30% at harvest, just because you needed the cash flow or to create space, but you were still bullish on the market, long term, you don't have to go out and sell another 10, 20% and get oversold from what you'd like. You can actually buy that 20, 30% that you sold at harvest back through the financial markets. So one of the things that you need to decide is deciding between using futures or call options. So you have the ability to re-own the grain you sold to an elevator, as I mentioned, without buying back a contract from the elevator, which we know they can get very punitive and come with aggressive fees. So your options are you can turn to the financial side of ag commodities. So you could, one, buy a futures. Now, both of these, buy a futures or buy a call, they carry risk. So when you buy a futures, you do have margin requirements and there is potential for a margin call if the market goes against you. So you buy a future, you're anticipating for it to go up in price. But say if the market just took a turn and the price moves down and it breaks through basically what your maintenance margin is, you will be getting a call to put more dollars in your account. So it then just becomes a drag on capital. So the other option is you buy a call option, and this would be our recommendation. Long When you're long an option, you have the limited risk to just your initial investment, essentially. So if you paid $500 in premiums to own an option, really the most that you can lose is that $500. And we're not going to take into account being matched with options or anything. We're thinking about it that you would always exit out before you got um, any futures matched to your option. So really your option is limited risk to that initial investment. So let's go through a quick little example here. You're bullish on the market. So you as a farmer, you produced 100,000 bushels of soybeans. At harvest, you sold 20,000, so about 20% of your production. As we know, harvest is generally going to have the lowest prices because you have a whole brand new big supply that's coming onto the market. So cash price is low, the futures and the basis. So say you sold at $10.40 a bushel. You did this, you needed to generate cash flow for bills, make the space on the farm, or you just didn't have any storage on your operation, so you needed to move everything at once at harvest. The logistics made sense, or you weren't looking to pay the storage fees at the elevators that can really end up dragging on your margin. So you've done all that on the physical side, but you weren't maybe too happy about it, and you're getting a little bullish about the market and wish you hadn't sold that 20,000 bushels. And now, right after that, you're starting to hear, rumors like we are today that China might be coming in to buy beans and buy beans in a big way. So the market's starting to get a little bit firmer. People are starting to get a little bit bullish. So you might have some regret selling that 20,000 at $10.40 as you think the market can run 40 cents and get up to $10.80 a bushel. It's a 40-cent a bushel difference. So what you do is you go long a call option. Remember, where our recommendation is call options because there is a more defined risk dollars than doing the futures. You can do the futures. But in this case, we're going to go long a call option with a strike price that's slightly higher than where we sold. So we're going to say we're going to buy December calls with a strike price of $10.60 a bushel. So it's going to cost us 15 cents. That's the premium on the option. So in these scenarios, what happens if the market rises? Market runs to $10.90. Say our call option goes from 15 cents up to 35 cents a bushel. That means we made an additional 20 cents a bushel profit. And we exited out of our call option at that 35 cents. So we got that 20 cents that's being held in our financial account. So that now we can equate it back because we were buying 20,000 bushels worth of call options. We can equate it back to that 20,000 physical we sold. So this now makes that 20,000 bushel sale that we did at 1040 worth 1060 now. That's the way to look at it between the physical and the financial side. Now, what happens if the market is flat? Say the market is relatively flat, maybe stays around 1050. We might be able to exit out of our option at 10 cents. Maybe we only lost 5 cents on it, so that's not too bad. So in this situation, this would make your 20,000 bushel sale lower though, because you did take that 5 cent per bushel on 20,000 bushel loss. So now that 1040 sale is actually worth 1035. But it's not bad because we were looking for a bullish market. 1035, is that too far off the 1040 from what ourselves and the rest of the market sold in? Probably not. But had we missed out on getting, 1060 versus our 1040, that's a big difference where maybe the rest of the market was selling at that, 1060. The other situation is, say the market falls off and soybeans are now priced at 1030. So our call option could be worth maybe a few cents, or it's completely worthless, and so we lost that 15-cent premium. In this case, that 20,000 bushel equivalent price is now the 1040 we sold minus the full premium. We're just going to say it expired worthless, so we lost 15 cents. So now the price we paid was $10.25. So that makes that 20,000 bushel sale that we did at 1040 really now only worth 1025. So what we're getting at here is you want to be looking at this financial and physical side together and what that is. And as you can see in these situations, there's not overall huge swings in it, but there is the ability to get that upside, especially if you are bullish on the market. I mean, the worst thing is on the long call side is the market falls off and the prices all go lower and we just miss out on the upside. But as you can see, if the prices do rise, we are averaging up that early harvest sale. And even if the market is flat, the rest of the market is still flat, probably selling at similar levels we are, and we're not too far off from them. The worst case scenario is that just the market falls off and the call option is worth less. So what are the outcomes and expectations? So 3 categories of outcomes. Market rises. The market followed our market view and helped average up our sales price on our soybeans. And it essentially is saying that by buying that call option when we were bullish, it helps average up the price that we sold at that harvest pressure, which also, when you think about it, helps us keep ourselves in the market, equivalent to maybe every other grower as well that maybe waited and sold at the higher price because they may have had the space, they may have had the cash flow. but it helped keep us on that higher price beans, which we all know need to generate some capital and things like that too. Market is flat. The market was relatively flat, slightly reduced our sale, but it still gave us the opportunity to average up our selling price without having to oversell our production to do that. So we still have our other 80,000 or 80% of our soybean production, and we didn't have to risk that. We did something relatively inexpensive at 15 cents a bushel on 20,000 that gave us, opportunity on the upside. And of course, the market falls though, market move lower, the option is near worthless. So, you lose out on that investment and have a slightly lower average price. But at the same time, if you see the market starting to fall, you have ability with options to get out before. So if you're saying, this market is actually not following that bullish trend I thought, I paid 15 cents, maybe someone's still bidding 10 cents for that call option. And you say, okay, I'll just sell it for 10 cents as well, right? So it's only a 5 cent. So you got to be following these markets and just having that right risk management plan in place, saying, market's starting to trend, not the bullish that I thought, maybe it's time to get out of this option. Thanks very much for joining. This was just a simple strategy here of ways that you can get back in the market. Also ways in order for you to essentially leverage up on bushels that you've already sold. Feel free to reach out if you have any questions on this. You can reach me at steven@simplehedge.com. You can also contact us at any of these numbers below. And don't forget to follow us on Twitter and Instagram. Thanks very much.